Most people quit investing during the exact phase that matters most. Not because they are lazy, not because they are bad with money, but because the beginning feels broken. You save for months, sometimes years. You watch your account crawl upward so slowly that it almost feels insulting. Meanwhile, online, everybody acts like investing instantly changes your life. But real wealth does not look impressive in the beginning. In fact, the early stage is so slow that most people mistake it for failure. Then eventually something strange happens. Your money stops depending entirely on you. The account begins growing faster than your monthly contributions, and for the first time, momentum becomes visible. That shift changes everything. This is money sitting in assets that can grow while you sleep. Index funds, retirement accounts, broad stock market investments, the type of money that keeps working even when you are not. For years, people imagine investing works like effort: work twice as long, get twice the result. That assumption destroys people because compounding does not behave in straight lines. It behaves more like pressure building behind a dam. At first, nothing seems dramatic. Then eventually, the force becomes impossible to ignore. Their own savings added 6 times more than the market did. That is the brutal psychological phase. You are carrying the entire machine yourself. The investments are barely helping yet. Imagine someone investing $500 every month. That is $6,000 a year. In the beginning, almost all the progress comes from their own paycheck. If the market grows 10% during the year and their account only has $10,000 invested, the market adds about $1,000. And this is exactly where most people lose motivation, because humans naturally want visible feedback. We go to the gym expecting visible muscle. We study expecting visible progress. We save money expecting visible wealth. But investing delays the reward, sometimes for a painfully long time. The first several years are usually dominated by discipline, not growth. Your behavior matters far more than your returns. Then eventually the numbers begin changing. At around $100,000 invested, something important happens. A normal market year at roughly 10% growth suddenly produces around $10,000 by itself. Now compare that to the $6,000 annual contribution. The investments are producing more than the investor. The first $100,000 might take close to a decade for someone investing steadily. The next $100,000 can arrive dramatically faster. Not because the person became smarter, not because they discovered secret investment. That is the crossover point, the moment your capital starts outworking your labor. And once that happens, the acceleration becomes obvious. The snowball simply became large enough to matter. At $200,000 invested, a strong market year can generate roughly $20,000. At $300,000, roughly $30,000. The difficult part is surviving long enough to reach that stage. Most people never do. The contribution stays similar, but the account itself starts creating increasingly larger amounts of growth. This is why experienced investors become obsessed with consistency, because eventually consistency transforms into leverage. Some increase their lifestyle every time their income rises. A slightly larger paycheck turns into more subscriptions, more expensive cars, bigger apartments, and higher monthly obligations. The extra money disappears before it can become invested capital. Others panic during market crashes. A portfolio dropping 30% feels catastrophic when you spent years building it. So people sell at the exact moment long-term investors are quietly buying assets cheaper. History shows this repeatedly. Markets do not move upward smoothly. Sometimes they spend years going nowhere. That reality discourages people who expected constant progress. But long periods of stagnation often create the conditions for future compounding, because every contribution during downturns buys more ownership at lower prices. The people who continue investing during ugly years are usually the ones who benefit most later. This is why investing is not mainly a math challenge. It is a behavioral challenge. The formulas are simple. The emotional endurance is hard. And despite what social media suggests, wealth rarely comes from dramatic decisions. It usually comes from repeated ordinary actions: automated investing, controlled spending, long time horizons, ignoring noise. But that is exactly how compounding begins. A tiny system repeated consistently becomes massive given enough time. Boring behaviors repeated for years. The irony is that these habits feel unimpressive while they are happening. Nobody feels powerful investing a few $100s automatically every month. It feels too small, too slow, too ordinary. There are countless examples of ordinary people building serious wealth this way. Not celebrities, not hedge fund managers, just people who stayed invested for decades while living below their means. The public usually notices wealth only after compounding becomes visible. They do not see the silent years beforehand. That hidden period is the entire game. And this is the misunderstanding that traps most people. They think the slow beginning means the strategy is failing. In reality, the slow beginning is the strategy. Every major compounding curve starts flat. If you zoom into the early stage, it looks unimpressive. If you zoom out decades later, it looks unbelievable. The difference is time. That is why the earliest dollars invested are often the most valuable. Not because the amount is huge, but because those dollars receive the longest runway to compound. Someone who starts early with average income often beats someone who starts late with a much higher income. Time multiplies consistency. And eventually, there comes a moment where your portfolio no longer feels like a fragile savings account. It begins acting like a financial engine. The growth becomes noticeable. The annual swings become larger. The compounding becomes visible. At that point, people finally understand why patient investors talk differently about money. Because they are no longer relying entirely on hours worked. Their capital has started participating, and that changes how the future feels. The important thing is understanding that the invisible years were never wasted. They were building the foundation required for everything that comes later. Most people want evidence before they commit. Compounding usually demands commitment before evidence appears. That is why the beginning feels so difficult. You are being asked to trust a process before the rewards are emotionally convincing. But once momentum appears, the entire experience changes. And eventually, you understand something most people never stay around long enough to witness. Wealth creation often feels invisible right before it becomes obvious. Not overnight, not magically, just gradually enough that one day you realize the account is growing faster than it used to, then faster again, then faster again. So if your progress currently feels slow, that does not automatically mean the process is failing. You may simply be standing in the quiet phase before compounding becomes visible. Stay consistent long enough, and the math eventually stops looking small. It starts looking unfair. And that is the moment when years of ordinary discipline finally become momentum.